Welcome to Tell Me More, a hospitality data podcast 2025. New year, but same old us. I'm Stephanie Ricca, as always, here with STR's Isaac Collazo and co-stars Jan Freitag, ready to kick off 2025 strong. Hi, guys.
Hey, Stephanie, but who are you calling old? I'm getting a little concerned here.
Happy New Year.
Happy New Year.
Oh, okay. We can still say Happy New Year, and then we'll say not same old us, but reinvigorated,
Nice.
optimistic us, right?
Go with that.
Yeah.
Let's
I can go with
just set the table strong. So, in case our listeners missed it in the chaos over the holidays, we released a bonus episode in early January where we looked into the crystal ball a little bit. We'll link that in the show notes in case you missed it. And because news changes so much, we'll have even more to talk about on that front today. On that note, we're going to organize this January episode of the pod a little bit differently so we have a chance to look back on 2024 a little more fully now that it's in the rearview mirror, and also to give a little more insight into 2025 as we see it now, because like I mentioned, news changes so fast. Sound good to you guys?
Sounds great.
Let's do it.
All right, let's tackle 2024 in review, starting a little bit closer to home. Isaac's going to start us off by waltzing us quickly through December hotel performance highlights. Isaac, how was December?
I never thought about singing it. That might be very interesting. But hey, here we go. I'm going to break it down, Steph, in a couple of areas. We're going to talk about December super brief. Then we'll go into Q4 a little bit deeper, and then we'll get full year. And then toward the end, we'll again go back into Q4 because there's a lot that happened in Q4 that we have to discuss.
Absolutely.
So beginning with December, RevPAR increased by 4.4%. That was the largest gain of the year and the largest since March of 2023. And it was all driven by ADR, which surpassed the rate of inflation for the first time since February of 2024.
Yay.
Yay, that's right.
Applause.
And we'll talk about that as well, because there's some very specific issues as we talk about the full year. For the fourth quarter, RevPAR was up 3.6%. Again, the most since the first quarter of 2023. And you remember the first quarter of 2023 had the Omicron impact. Remember the year over year? So that was really strong RevPAR growth in that quarter. Occupancy was up a point, and ADR was only up 1.9%. Keep in mind that inflation has been about 2.7% for the quarter, if I remember correctly. So again, below the rate of inflation. Importantly, room demand was up in each of the 3 months of the quarter. That's something we hadn't seen in a while. And RevPAR growth in the top 25 and all other markets was exactly the same. If you recall, early in the year, we were talking that top 25 markets were leading the nation and really were driving growth in both demand and RevPAR. But in this quarter, exactly the same. Looked at every metrics, and they were basically exactly the same for every metric. In the top 25, 5 of the top 25 reported double-digit RevPAR gains, led by Tampa with a 34.3% increase.
And this was the quarter, Isaac, right?
This is the quarter,
Okay.
Correct.
All right.
And then that was followed by New Orleans, Houston, Chicago, and New York. Couple of key points for New York in the quarter. New York had the highest Q4 occupancy of any U.S. market, 88.5%. More importantly, that was equal to the 2019 level. But when you break it apart, not every month in the quarter surpassed 2019. It was only October that surpassed 2019. November and December were actually lower. Yeah, I see that was really interesting. I assumed that it was the entire quarter as well. I can see from your facial expressions there, Jan.
So October had to be pretty good.
October was really good. I think that's when we had the UN, the whole UN thing in New York, General Assembly. I couldn't think of that. Tampa, Boston, and Houston also had Q4 occupancy above 2019. So that's kind of just a wrap up on the quarter. Now let's look at the full year for the U.S. RevPAR was up 1.8%, all on ADR, which was up 1.7%. Keep in mind, inflation was 2.9% last year. So that means real ADR to 2019 is down 1.7%. A year ago, it was only down 0.5%. So we've gone backwards. And when you think about it, I broke it up in halves too. The first half, ADR grew at 1.8%, inflation was 3.2. Second half, ADR grew at 1.6%, and inflation was 2.7%. And taking a little deeper, what does this mean? I mean, why do we care about this? What we see is hotels see profit declines when ADR is below the rate of inflation. And in fact, GOP is down 1.4% percentage points this in the full year to 35.5% versus last year. And again, when you think about what's driving that decline, not only is it lower ADR increases, but labor costs continue to rise. In the sample that we have in the P&L, labor costs are up 11.2% year to date. So again, there's a lot of expense costs there. And again, we are starting to see that impact. And then I did even deeper dive because I just was interested. Only 32% of hotels that had comparable ADR, both this year and last year, saw that measure rise higher than the rate of inflation. So just a third of hotels grew ADR better than the rate of inflation. And
Jan, can I jump in real quick? Jan's been making some facial expressions for our listeners. So what's your so what take on that? A lot of these numbers we kind of saw coming. You know, we've been talking about this throughout the whole year, but to hear it in that perspective, what's your gut so what, Jan?
Yeah, I mean, a lot of owners are looking at these numbers and they're saying, right? 11% labor cost increases. That is likely not going to change. We may talk about the new administration and they're clamping down on illegal immigration, but unfortunately, there might be spillover effect to the labor industry, to the labor costs to our industry. So I'm very, very curious to see that. I think just in general, this idea that we can reset our prices every night and therefore the hotel industry is a good inflation hedge, that used to be the common wisdom. And Isaac's telling us that's actually not the case. And we actually went backward compared to 2019, compared to when we look at 2023 versus 2024, compared to 2019. That is not good news for the bottom line and not good news for the owners.
And there's so many things happening. Again, some of the ADR, because this is average daily rate, as we well know, right? So some of this could be remix, right? Mixing. We've had a change in the mix in business. We also have downward pressure on middle and lower income individuals who may not be traveling. There's so much going on. Obviously, corporations are watching costs. So you could have managed rates also under pressure. So, I mean, there's a lot there, but the net is you're seeing ADR well below the rate of inflation. I think that's the key message. So, and there's an impact.
Yeah, I mean, somebody should coin a phrase, maybe bifurcation, because the room rate changes are on the lower end. Certainly we see ADR flat or declining versus upper upscale. It's actually okay.
But luxury went backwards, if you remember. I didn't look at all the chain scales this time around, but yeah, it had been going backwards. So that probably hasn't changed. And as we continue down to the performance side, as we finish this section, 65% of markets, 112 of the 171 saw RevPAR growth. And again, led by really interesting markets, Houston with 15.1%, and followed very closely by Augusta, Georgia, and others with double digit were Columbia, South Carolina, and Greenville, Spartanburg. So hold on to that because there's more that we have to unpack there. Only a third of all markets saw RevPAR increase at or above the rate of inflation. So again, like hotels, markets have performed exactly the same thing, just a third. And then the only sharp decreases we saw were in Maui. And again, that's still effects from the fires they had there a year ago, right? So they're still hurting from that. Fort Myers, that was also reversal because in the prior year, there were those recovery efforts from the hurricane. And then one I didn't look at was California North Central. And everything I saw essentially was driven by falling occupancy. Those that were really coming down in terms of RevPAR, again, occupancy driven. And then just really quick on the globe, global RevPAR with the U.S. was up 6.9%. If you take out the U.S., it was up 8.2%, all on ADR. So again, being ADR driven, among the 10 largest countries, we base it on supply. Japan saw a RevPAR gain in the quarter of 20.6%. Mexico was up 17.1%, and Thailand was up 16.7%.
Boy, Japan got the memo, right?
They got the memo, and we saw that all year long.
Mm-hmm.
And in terms of the top 10, the only two countries that went backwards were Saudi Arabia and China. Saudi was on occupancy, and China was on ADR. In terms of full year global growth, RevPAR was up 5.3%. Without the US, it's 6.9%. And again, not surprising, Japan led the largest countries. They had 19% RevPAR growth for the full year. So again, very similar to what we saw in the quarter. Thailand, Indonesia, and Spain all saw double-digit full-year RevPAR gains, again, all on ADR. And China was, again, down 5% on falling ADR and a little bit of decreasing occupancy. I looked deeper into that. I looked into the markets. I looked into chain scales. Again, it was supply growth outstripping demand. And a lot of that supply growth was in the upper mid-scale and mid-scale classes. In fact, 67% of the available room night growth was in those two classes. And then ADR was down across the board. Final things. What we should know about global demand is that it is 6% higher than what it was in 2019. So demand outside the US is still very robust, and again, much better than it was prior to the pandemic, while in the US, demand is down 1.3% versus 2019.
Yeah, we keep knocking on that door. We're almost there. We're almost there. We're not quite there.
And we had predicted that 2025 would be the year we'd get there, and we did not. Or 2024, sorry. 2024, sorry.
So let's predict it for 2025.
Let's predict it for 2025. I'll go with that. And then real ADR outside the US is also down, and about a similar rate. Again, you'd have to almost do it by country, and we do it at a global CPI level, but on a global CPI level, it is still down. So that's the quick wrap up of performance for December, Q4, and full year. That's a lot of data.
Yes, that US versus international demand percentage, versus 2019 was the first I'd heard both those together. Interesting. So Isaac, take us back to a couple of those markets that you told us to put a bookmark in. I think a lot of listeners will understand what the through line might be here.
Yeah. And my first little bullet, because, I do make bullets, so I remember what to talk about. And the first thing I wrote was the performance improvement we saw in Q4 is not a trend per se, but it could be. And here's why it could be. Because what's happened in this is it's really being driven by 13 markets. Those 13 markets are Augusta, Charlotte, Columbia, Daytona Beach, Florida Central North, Florida Central South, Georgia South, Greenville, Spartanburg, Macon, Warner, Georgia, or Warner Robins, Georgia, North Carolina West, Sarasota, South Carolina area, and Tampa. What do they have in common in the fourth quarter?
Oh, tell us.
Tell me more. I think we have an idea, but it's not a good thing, right?
Yeah, Hurricane Helene and Hurricane Milton. So let's break it down. U.S. demand increased by 6.7 million room nights in the fourth quarter. It's the largest gain again since first quarter of 2023. 41% of that gain came from the 13 markets I just mentioned.
Wow. Yeah.
So, big driver. In terms of the demand growth in those 13 markets, they were up 16.7% year over year versus 1.2% for the remaining markets. Lower tier hotels, upper mid-scale down, accounted for 88% of the room night growth in those markets. So even in the chain scales, when you see that the economy and mid-scale are doing much better in the fourth quarter, again, it's not a trend change per se. It's because of these 13 markets. And the reason I say it can be because we expect these 13 markets to continue being a big driver, at least until the third quarter of next year, because it's going to take that long, right? So fourth quarter next year, they could be a big reversal, and you're going to see an unbalance because these 13 will no longer be delivering the demand that they're delivering currently.
Yeah, people are going to be displaced for a long, long time, right? The residences that were destroyed, unfortunately, the multifamily housing units that were destroyed, people are looking for shelter, and hotels obviously provide that. But for some time, it's going to take a while for the rebuilding effort. Yep. And so then, therefore, that means the room demand is going to be elevated.
What was surprising to me when originally we identified 7 markets. Some of these we hadn't identified in the very first draft when we started looking at the data. So I started looking at demand trends, and literally you're looking week by week, and you get to week 39. That's when Helene hits, and you just see this jump, and then it's consistently high. And that's how we started identifying the markets. Some of you may be like, why isn't Orlando there? Or why isn't there's another market that didn't show up? It's only because of Florida Panhandle didn't show up because they didn't see that continuous lift. So you see the lift when the hurricanes hit, but then they come back down to more normal growth patterns. And that's why those 13 exclude Florida Panhandle and Orlando. But very fascinating. And the other markets we have 41% of demand coming from 13 markets. And then there's another 6 markets that account for 50% of that remaining demand. And again, one of those is Orlando, but some of that, again, some storm related, but also conferences. That's what I could see.
Mm-hmm.
Houston. Remember, Houston had the highest RevPAR growth. Well, guess what drove Houston? Again, weather. In May, they had what was called the derecho, and 16th of May, lots of flooding, and then Hurricane Beryl in July. And that also resulted in displacement and contractors and everything else that comes with storm-related damage. And then other markets that continue to grow very strongly that had nothing to do with weather was Chicago, Washington, D.C., and Columbus, Ohio. And so wrapping this all up, if you exclude the 13 hurricane markets, U.S. Q4 RevPAR was up 2.7% versus the 3.6% that were reported. And again, so it was still a good quarter, but you got a very significant increase from those 13 markets. And even ADR was much stronger in these hurricane markets, 5.1 versus 1.9 nationally. And we're continuing to see this growth. So I looked at the first 3 weeks of the year of 2025, and these 13 markets are still adding 1.1 percentage points to RevPAR growth. And we expect that to continue for some time.
Such an odd thing, isn't it? Growth, but at what cost? Sobering type growth, because this year's market that can absorb recovery might be next year's that gets hit.
Mm-hmm.
It's such a influx type of demand scenario.
And there's no way we can build this into our forecast, because someone asked me, why don't you build in? There's always hurricanes, there's always storms, but you don't know what markets, you don't know how it's going to impact it, you don't know the extent. This was far-reaching. Normally, it's more localized, like Fort Myers. When they had it was very localized, and that was easy. This was more far-reaching than I ever expected, just because of the flooding that the storm, even though it wasn't the winds, it was the flooding, and that was widespread. So it's difficult to build this in. So that's one of the reasons it's odd. We were like, how did we miss our forecast so much? And then you start breaking it apart and you go, okay, we couldn't have anticipated that. The forecast would never have anything like this in it, because there's no way to handicap it and said, we expect a storm in the fourth quarter. Let's put this down, bring down or raise the forecast, whatever. So can't do it.
Let me just add one little asterisk to the ADR percent change, which you said for those markets that is above what the national level was, and so we don't get angry letters about price gouging. I was talking to a colleague today, an operator in LA, and we're going to talk about the LA wildfires in a minute. But it turns out that FEMA actually pays above per diem. So this is not, and I assume a lot of these markets, probably hadn't seen a lot of per diem customers, so they probably get at least per diem, if not more. So that would just drive ADRs naturally without the hoteliers, doing anything nefarious. Right. I just want to call that out.
Yeah, and the displacement rates tend to be pretty good rates for individuals, self-paying individuals. But then anyone else going on vacation, these are still vacation spots, especially in Florida, and this is their season. You're also going to see that upward pressure, right? Because whatever rooms are remaining, demand is high. There's not a lot of supply.
So many pieces to this puzzle right now. We see Asheville, trying to make a push of, hey, come on back. Some of the major hotels that were impacted at that moment are open and trying to ramp that back up. So it's a really, really dynamic and changing map. So let's stay in 2024. And Jan, you've got some commentary to add on full year transactions, as well as some financing trends. CMBS have been in the spotlight for a while. Where did we end 2024 in terms of transaction and financing?
Yeah, so the slow and steady transaction environment is clearly seen in the data. So this is the second year in a row that the total transaction volume had declined. Last year, 2023, we sold $25 billion worth of assets. 2024, we sold $21 billion worth of assets. So a deceleration, while at the same time, the price per key actually went up from 150,000 to 177,000 or so. Part of that is probably just general run up in prices. Part of it is also that the makeup of deals, right? The upper end of the market continues to sell quite well. You saw the Hyatt, selling for $1 billion in Orlando. And so high-end deals will continue to take place, and that's what we expect for this year as well. As the interest rate environment eases, and there might be some cuts on the horizon for interest rates, hopefully that then will spur more deal activity. With the ALIS conference this week, and I'm talking to all the brokers and all the owners to say, what are you seeing? What's in the water? Tell me, how do you read the tea leaves about what transaction volume will end up for this year? And we have, some predictions that it's going to accelerate a little bit, not at a steep pace. The other number that I just want to throw out is the CMBS financing volume, which in 2024 came in at around $20 billion. Why is that number interesting? For two reasons. Number one, it is actually more than the sum of the last 2 years combined. So in 2022, we had just under 12 billion, 2023, just under 8 billion. So now we have $20 billion on the CMBS. That's roughly 40% of all loans that were written. The other thing that I thought was really interesting, just a little data nugget here, that is the second year in a row that we have securitized more hotel assets than office assets. So the office CMBS loan origination was 16 billion. For hotels, it was 20 billion. So if you had told me 10 years ago that there would be a year or two we would securitize more hotel assets than office, I would have said, no, that's not going to happen. Why would that ever happen? Well, we are there. Office are a little bit toxic right now.
The office
it's very,
hangover.
very hard to resell those tranches of those loans. And hotels are, doing quite well. And Isaac keeps reporting the data, that things are slow and steady. And the forecast that Amanda Hite and Isaac's team will put out, or did put out, I guess, by the time you listen to this at the ALIS conference, will be just around that, like slow and steady growth. So that's really interesting. Just one other quick number. People ask about default rates and delinquencies. Really not a big topic. The delinquency rate has been between 5 and 6% for the last 24 months or so. I don't see that changing. I did a quick look at what is actually delinquent. And sorry, this is a lot of numbers, but 95%, so basically all of the loans that are delinquent have been delinquent for over 24 months. So there's not a lot of new delinquency. Yeah, sometimes somebody misses a payment, it's 30-day, 60-day delinquent, but there's not this wall of distress that we have been talking about since 2021. And we said in 2022, we don't think it's going to materialize. Well, it hasn't materialized. And I think at this point, with the CMBS market wide open for business, it probably will not. So that's the recap of asset trades and CMBS.
So no wall of distress. We can officially take it off the table for 25. I think we feel safe doing that.
Yes.
New year. I said same old us, but we're going to say new year, new us. Now we're going to turn our thoughts in the episode to 2025. Like I mentioned at the top of the episode, we did a special kind of broad strokes preview of the year that published in early January. But how times change. And again, we talked about the weather disasters of last year, starting mid-year, pretty much to the end. So far already, January has really gotten off on somewhat of a similar disastrous weather front, with the fires ravaging through LA as we speak. Hotels as an asset class did not feel much impact, primarily residential and other commercial retail and things like that. But of course, these kinds of things have trickle down effects across the board. So we've had LA wildfires already this year, and the US presidential inauguration. This is here. It's now this week. So a lot of what was speculation is going to start to quickly turn into reality. Again, these macro issues, weather issues that will have an impact on the hospitality space. Isaac, what do you think? First, let's talk about wildfires. What impact on hotels, LA area are we really going to see? Is it primarily housing evacuees?
Yeah, pretty much. But it's double whammy. Not only the evacuees will prop up demand, but not market wide. And then you have people not going to the market because they're fearful that the fires and or the smoke, the air quality, could think of the word, is not healthy. So I think it's a double whammy, or I don't know, it's a whammy, but it's a pro and con, I guess, better way of saying it. So what we've been looking at, we first have to define the greater LA area because it's more than just the Los Angeles market. So we're looking at Los Angeles as a market. Then we're also looking at California's Central Coast, which includes Santa Barbara, Oxnard, Ventura, Inland Empire, which includes Ontario, San Bernardino, and Palm Springs, and then Orange County, which basically is Anaheim. It's a new name for Anaheim. What we've seen to date, and really the fires begin on the 7th of January, and that's when the big evacuations start. And then again, Wednesday being the peak evacuation day. So we started our analysis looking at Tuesday, Wednesday, Thursday. Now we evolved from Tuesday onward to the 18th. So from the January 7th to January 18th is what we're looking at. So it's been kind of, it's been limited impact, but it depends in what sub-market you're in. So we're looking at the market itself, not a lot. The sub-markets actually you're seeing a lot. So in the week ending the 11th of January, we only saw the impact on those peak evacuation days because Friday and Saturday were down. And that was weird. And we're looking at demand. So when I'm talking about performance, I'm just looking at the demand side. Occupancy over the 3 weekdays increased 10 percentage points, Tuesday, Wednesday, and Thursday. But weekend occupancy was down almost 4 percentage points. And we were just surprised. And again, there's some other noise there because a year ago, that would have been the Martin Luther King holiday. So we think there was some noise there. But when I looked at the absolute demand, it was all down across the board. Now, when you include now the week ending the 18th, now you're looking from the 7th to the 18th, demand is up 7.5% in the greater Los Angeles market. And so occupancy is averaging about 67% or 65.5% versus 61.2% a year ago. So you're seeing a little bump up there. But that's not the story. The story is in that submarket side. So when you start breaking it down, Pasadena, Glendale, Burbank submarket, it's up 33.6% in demand since January 7th, with double-digit gains nearly every day. Again, that's coming off that was the I can't think of the fire, the Eaton fire, which was close to Pasadena. And then others with double-digit gains include Los Angeles East. That's the area between Pasadena and San Bernardino. So you're not into the San Bernardino area, but just again, south and east of Pasadena. And then we're also seeing Los Angeles North, which is the San Fernando Valley, and Palm Springs, Santa Barbara, Newport Beach, Dana Point, Riverside, San Bernardino. And so they're all seeing double-digit demand gains. So that's where people are going to get away from the fire. So basically, on average, in those markets, those submarkets, occupancy is running 10 points higher than they were a year ago. But again, there's also losers. Over the past 12 days, demand in downtown LA is down 7.7%. And in Hollywood, Beverly Hills, it's down almost 16%. So again, these are the big tourist markets. And if you looked at Disneyland, I didn't put it down, I didn't put it in my notes, but Disneyland was also down by a huge amount because people are staying away from LA. So all the tourist side, even though we're seeing demand from displacement, but the tourism in those market areas that are not affected are seeing the declines. And in fact, Jan sent me something last night, which was we're planning a dinner because we're all going to be together. So we're going to have a dinner. And the Eater LA had this note saying, please come to eat downtown. Please come to restaurants. Restaurants are hurting because no one is going out because, again, of the air quality issue. A lot of groups are canceling. So again, it's a double whammy.
That's the impact that I will be interested to see after Q1 is that group, because that is not that is not easy to cancel. That is not good for your finances to
Right.
cancel. And it's also, I mean, typically I would say done without many people on the ground to report back whether there really is an issue,
Right. And so,
forcing a cancellation.
right. And again, I know this conference is going on, which is at first people questioned why we're doing this, but it may actually be the good thing because, again, people do the tourism industry in LA, obviously, is a very vibrant part of that economy. And it is also now hurting along with everything else that the fires have impacted. And of course, we have the new fire that just broke out, the Hughes fire. And so I haven't seen much yet on that, but it's too soon. We wouldn't see it in the data yet. But that just happened yesterday, so we'll be watching that one as well.
Jan, your thoughts?
We're hotel people hoping to support hotel people, and Jeff Higley, the organizer of the ALIS conference, has been very clear. Look, we're open for business. Come one, come all. We're trying to do our part. And I appreciate that Isaac's going to organize a dinner or two in a restaurant that is really looking forward to welcoming out-of-town guests.
That was weather. That's continuing. And again, it kind of falls back to those same storylines that we have with what happened last year and hurricanes, is that kind of displacement takes a while. Isaac, have you broken down this look at LA and greater LA by classes yet?
Yeah, we did. And so, because again, we've been looking at the demand side because that's typically where you see displacement, right? And anything else. We did break it up by classes. What we found when we broke that out, I was looking at ADRs. ADR growth has been very minimal. I think it was like 1% or 2%. It was very low, except in luxury. And what we hypothesized on the luxury side, it was in certain markets like Santa Barbara, and then also going down to Santa Monica, is that the people that were staying at those hotels probably were buying room types that wouldn't be normally sold at this time of year, like suites and things. So we think the average daily rate was being impacted not by increasing prices, but more by the change in room mix. So, but that's all we did. We didn't see much differences in terms of the demand. So it was pretty across the board. Obviously, if you're leaving and you got to sleep someplace, you're going to whatever is available. So I didn't look at it this week. We're going to look at it. Obviously, we'll continuously look at it. But at this point, the only thing we noticed was the ADR piece originally. And
yeah, the data that you shared with me and that we published, right, that for just the time period between the 7th and the 11th, luxury ADR was up 21%, but it was also up 22% in Hollywood, Beverly Hills. And clearly there's an overlap between high-priced hotels being in that neighborhood. And that then drove up the market because the people who lost homes that were worth multiple millions of dollars probably have the money to say, hey, I would like an apartment, I would like a suite. So again, I was talking to a reporter earlier this week about price gouging and what does the data show, and there's not a story there. The run up in the luxury ADR I think can be clearly explained by the way Isaac explained. It's just a change in room type
and the individuals that were impacted, specifically the Palisades fire. Right. So that different type of individual. And so that are willing, that don't want to stay in a single room like you and I, and they want to bring the whole family and do something a little bigger and nicer.
That will be really interesting to see how it plays out because, again, such a dense residential impact.
Right.
But what kinds of residences, you can't paint it with too broad of a brushstroke, but there are factors at play into where those displaced people will go for the next however many months it takes to rebuild. We are, like you mentioned, headed to ALIS this week in LA, where we will get, a good crowd of hospitality people who want to make a difference in a city that has been hit pretty hard so far this year. Jan, I know you always have a lot of thoughts about what we can expect to hear at ALIS. I want to hear from you what you think those major ones are. The one that I'll contribute that we've been hearing about again and again in this run-up has been impacts of election and a second Trump presidency term. There's pros, there's cons. People in the hospitality industry are often very vocal about both of those things. But now that it's here, it's real, and we see action starting. I think it's becoming a lot less speculative and a lot more reality. What are you seeing heading in this week, Jan?
Yeah, Alice is a gathering of a lot of finance types, investors, owners, brokers, lenders. And I think so interest rates will be a continued conversation. Will we see higher for longer interest rates? Will the Fed actually make a move? The new president has been very vocal about where he wants interest rates to move. The Fed chair seems to be a little bit more cautious. So the question is, how many cuts are we getting? I've heard from one macroeconomics forecaster, Moody's, economy.com, said, well, maybe we don't get any cuts at all this year. So I thought that was a sort of a counter narrative to what the prevailing sentiment is right now. So interest rates are on everybody's minds. What's the deal flow? I talked about it earlier. You see a lot of brokers as Alice ramps up putting out, hey, this hotel's for sale. We're selling this hotel. We've been tasked to put this hotel in the market. So we're going to see a lot more chatter. The question is, are we going to see a lot more activity? And then I think the impact of the new administration rules, especially on curtailing immigration and not letting people coming into the country who want to work here and deporting illegal immigrants, that's going to be a large conversation. But I think the other part is going to be the maybe chilling effect on the reputation for tourists coming into the United States. Now, the dollar may not help. The US is right now pretty expensive if you're coming from Europe or you're coming from Asia. But B, the question is, do people feel welcome if the borders are quote unquote closed? I mean, they're not fully closed, but you know what I mean. So those are, I think, a couple of the topics that are on operators' minds, that are on owners' minds. And I'm very, very curious to hear what we're seeing. And of course, pay attention to press releases that come out Monday night, as they always do, about which brands is making a move, which REIT is making a move. So looking forward to all of that.
Hotel News Now, stay tuned because we, of course, will be there with all of the breaking news. Isaac, what do you think is going to be top of the talk?
Well, what I'm looking for and trying to hear for is what kind of optimism or pessimism there is. What's on the books? What are we hearing? Because I've already been hearing from my friends and in the business. So I want to see more general, because again, my friends are very specific in certain companies, as you well know. So I'm trying to see, is the pro-growth stance of this administration already starting to impact occupancy on the books? Are we seeing anything at this point? It's very hard right now because it's only January. And again, we've had weather issues, you have the wildfires. So it's hard to really say, January is the gauge that we need because everything's changing. But I'm just looking for that. And then I'm also trying to think for, again, just a sentiment. Are people excited about the year? Are they pessimistic? Normally Alice kind of sets the tone. You can really get a feeling for the year just based on the cocktail talk you have, right?
And no one has real clarity, but they will make predictions anyway.
Exactly. Yeah,
exactly.
But I mean, it at least helps us. And I'm just trying to confirm or disprove some of our hypotheses, right? It's like, okay, we're on the right track. Oh no, we completely missed that. So that's what I'm kind of just looking for. So it really is just talking to people. That's why we go to these things, just to talk to folks and see what they're thinking and what we should be thinking about as we forecast for the industry.
And I'll remind you, Isaac, that last year you committed to you personally being back to your optimistic self, of course. The data always tells the truth. So
data always tells the truth. That's exactly right.
We'll talk to anybody at a cocktail reception, optimistic or pessimistic, right?
For those of you listening, if you'll buy me a martini, I'm your friend.
Optimist, pessimist.
Yeah,
we're all friends martini at the reception.
If you buy me martini and you're pessimistic, I'll be pessimistic with you, and vice versa.
Only if you got to make sure there's an odd number of olives in that glass.
Exactly.
So find us at the Alice conference. We're ready to have a conversation about data or talk about your favorite drink.
Look for the two guys with no hair that look alike.
Who will be at the bar. Okay, we're at closing time, and I will apologize to listeners who've made it all the way through. We've gone a little bit long this episode, but hey, it's our first time getting together in January. We had to put a bow on 2024 and get ready for next year. But one thing that will not change is the way we close this podcast, because guess what? You love it. Listeners love it. We think at least nobody complains about it. At the end of every episode, Jan and Isaac share a metaphor. some sort of symbol. The industry is like a blank right now. And you know what? Everybody loved it so much last year that we created a Spotify playlist with all the songs these guys referenced throughout the year. We'll include a link to that in case you missed it as well. But Jan, why don't you get us started? How does the industry feel right now? What's your metaphor?
So Christmas is behind us, and our boys got a random, very awesome gift, which is the Monopoly game Nashville edition. And they had never played Monopoly. So I got to teach them Monopoly. And guess what? At the end, when you are the winner, what do you have the most of? Hotel.
Hotels.
So I am teaching my boys buying and selling hotels. And so to me, the industry is like a good game of Monopoly where at the end, everybody wants to be in hotels.
I love it. We have never made that connection before, but what a perfect way to get them started right away in the highs and lows of buying and selling.
And what's unique is my metaphor ties into the same city we're in, Nashville. So isn't that amazing? So I had the opportunity, last minute opportunity, bought some tickets to go see Ringo Starr at the Ryman. If you've never been to the Ryman, you've got to go to the Ryman. What made this special was he recorded a country album, not his first, his second, but the previous one was like 30 years ago or something like that, a long time ago. But he debuted that album at the Ryman with all kinds of friends, Jack White, Billy Strings, Emily Lou Harris, you name it, they were there. Incredible show. But the song, so before the concert, I have to listen to the album, which came out Friday before the show on Tuesday. And he has a song that I think is a perfect metaphor for the beginning of the year as we get to Alice and as we think about everything that's happening. And the song is the title track from the album, Look Up. And I think that's what we should do. That's the optimistic me coming in. Like every storm, the rain won't last. So you got to remember those kind of words. Roll away the stone, look up, look up. So look up. It's a great album. If you like it, it's very Beatle-esque because it is still Ringo Starr. But you realize when you listen to the album how much country music had an influence on the Beatles. It's incredible. I never thought about Beatles music that way. So
look up. I think we might need a karaoke night in 2024. I mean, yeah. If we're making predictions, maybe. We'll see. As always, thank you both for your insight. And thank you to our listeners. Welcome back for another year of Tell Me More. Find the latest global hotel industry news on hotelnewsnow.com. Find this podcast wherever you like to listen and subscribe. And look for us at Alice This Week in LA. Thanks. See you next time.
See you at Alice.
See you at Alice.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen and Lodging podcast on the Hotel News Now podcast network. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of the Hotel News Now podcast was recorded on January 23, 2025 by me, Stephanie Ricca. The episode was edited by Sean McCracken. Find all hotel industry news at hotelnewsnow.com. Subscribe to this and all Hotel News Now podcasts wherever you like to listen. Just search for Hotel News Now. Thank you.